53%. That is how much retail cash flowing into U.S. stocks jumped in early 2025 versus a year earlier, according to Reuters citing J.P. Morgan analysts. That pace was even hotter than the meme stock surge of 2021. At the same time, 62% of Americans reported owning stocks in 2025, near the highest level Gallup has recorded in the last 2 decades. More people are in the market, more money is moving fast, and yet most beginners still ask the same question. Where do you start? Without turning investing into expensive guesswork. By the end, you will know exactly how to start investing in the share market, which accounts to use first, how ETFs and index funds fit into a beginner plan, when trading makes sense and when it becomes a performance trap, and the specific steps that help you build wealth without gambling with your future. Start with this reality. The stock market is not a side hustle machine. It's even beater if some stalkers any wall. It is a pricing system for ownership in real businesses. When you buy a share, you are buying a claim on future profits, cash flow, and growth. That sounds simple, but most mistakes happen because people treat stocks like lottery tickets instead of productive assets. In 2025, retail participation stayed elevated. Gallup found 62% of Americans owned stock, matching 2024 and sitting near a 2-decade high. Charles Schwab's 2025 Modern Wealth Survey found 54% of Americans said they currently invest, and about 2/3 said success today requires going beyond traditional stocks and bonds. That tells you 2 things. First, investing is no longer niche behavior. Second, competition for returns has increased, which makes discipline more valuable, not less. There is also a major difference between investing and trading. Investing means committing capital to compound over years through diversified ownership, usually using low-cost index funds, broad ETFs, retirement accounts, and automatic contribution. Trading means making shorter-term decisions based on price movement, valuation changes, earnings surprises, sector rotations, or momentum. Both can exist in the same market. They should not play the same role in your life. The evidence strongly favors long-term investing for most people. Schwab found more than 60% of Americans think today's market requires a long-term view, and nearly 70% of investors say they are more patient now than when they started. That patience matters because compounding needs time. Nothing replaces time. Let's make this practical with a real comparison. Suppose you invest $500 per month into a broad U.S. stock index fund and earn an average annual return of 8%. After 10 years, you would have contributed $60,000, but your balance would grow to roughly $91,000. Stretch that to 20 years, and your contributions become $120,000, while the account could reach about $294,000. Move to 30 years and your total contributions rise to $180,000, yet the balance would be around $745,000. The gap between money invested and money accumulated is compounding. That is how ordinary incomes become serious wealth. This is why beginners should focus less on finding the perfect stock and more on building a repeatable system. Process beats excitement. Before you buy anything, you need the right sequence. First, build a cash reserve. Most professionals should keep 3 to 6 months of essential expenses in a high-yield savings account or money market fund. If your rent, groceries, insurance, utilities, and debt payments total $3,500 per month, that means $10,500 to $21,000 in liquid reserves. Why does this matter? Because if your car dies, your job changes, or your medical bill spikes, you do not want to sell investments in a bad month just to survive. Forced selling destroys long-term plans. Liquidity protects discipline. Second, capture free money. If your employer offers a 401k match, start there. A common formula is 100% match on the first 3% of salary, or 50% match up to 6%. If you earn $80,000 and your company matches 50% of the first 6%, contributing $4,800 gets you another $2,400 from the employer. That is an immediate 50% return before the market does anything. Few investments can compete with that. If you ignore the match for 20 years, you are not just losing $2,400 a year. You are losing the compounded value of that match. At 8% annual growth, $2,400 invested each year for 20 years could become roughly $118,000. Free money matters. Third, consider a Roth IRA if you qualify. A Roth IRA is funded with after-tax money, which means no upfront deduction, but qualified withdrawals in retirement are tax-free. That structure is extremely powerful for younger workers or anyone who expects to be in the same or a higher tax bracket later. Imagine you invest $7,000 per year, roughly the current annual contribution limit for many investors, and continue for 30 years at 8%. Your total contributions would be $210,000. The ending balance could be around $793,000. In a Roth IRA, qualified withdrawals on the growth can be tax-free. That is not a small detail. It changes the amount you actually keep. Traditional 401k and Roth IRA decisions should be based on taxes, not trends. A traditional 401k gives you a deduction now, lowering taxable income today, while taxes are paid in retirement withdrawals. A Roth IRA gives up the deduction now in exchange for tax-free qualified withdrawals later. If you are in a lower tax bracket early in your career, the Roth structure often deserves serious attention. If you are in a high bracket today and need current tax relief, the traditional option may carry more weight. The key point is that the account wrapper matters almost as much as the investment inside it. Keep more of what you earn. Now let's address the easiest way to start in the stock market without pretending you can forecast the next winner. Use broad, low-cost index funds, or ETFs. An index fund is designed to track a market benchmark, like the S&P 500. An ETF, or exchange-traded fund, is a fund that trades on an exchange during the day like a stock. Many ETFs are index funds, but not all index funds are ETFs because some are mutual funds priced once per day. For beginners, that distinction matters less than cost, diversification, and behavior. If you buy a total U.S. market fund, an S&P 500 fund, or a total world stock fund, you are buying hundreds or even thousands of companies in one purchase. That diversification lowers company-specific risk. You are no longer betting your future on one earnings report. Costs matter more than most beginners realize. If Fund A charges an expense ratio of 0.03% and Fund B charges 1%, the difference looks tiny in a single year. Over decades, it becomes a drag on wealth. Assume you invest $10,000 and add $500 per month for 30 years, earning 8% before fees. At a 0.03% fee, the ending value is close to the full compounding path. At a 1% fee, your net return drops to about 7%. That 1 percentage point can reduce your ending portfolio by well over $100,000 depending on the exact contribution timing. Fees are certain. Outperformance is not. Respect arithmetic. So what should a beginner actually buy first? For many people, a strong starting framework is simple. Use a broad U.S. stock market, ETF, or index fund as the core. Add an international stock fund for global diversification. Include bonds only if your time horizon, risk tolerance, or cash flow needs require lower volatility. Younger investors with stable jobs often hold a heavier equity allocation because they have time to recover from downturns. Someone within 5 years of needing the money should think differently. Time horizon should drive allocation, not headlines. Here is a sample educational framework, not a one-size-fits-all prescription. A beginner in their early 30s with stable income, no high-interest debt, and a 20-plus year horizon might use 70% U.S. all stocks, 20% international stocks, and 10% bonds or cash equivalents. Someone with a shorter horizon might choose 60% stocks and 40% bonds. The classic 60-40 portfolio exists for a reason. But even that is not a law. Your allocation should match your ability to stay invested during stress. If a 20% drawdown would cause panic selling, your stock allocation is probably too high. The best portfolio is the one you can hold through bad years. That brings us to risk. Stock markets do not move in straight lines. The S&P 500 has experienced multiple declines of 20% or more. During the global financial crisis, U.S. stocks fell dramatically from peak to trough. In early 2020, The market dropped with startling speed before rebounding. In 2022, both stocks and bonds struggled as inflation and interest rates reset asset prices. This is why beginners should stop asking, "How do I avoid volatility?" and start asking, "How do I survive volatility without quitting?" The answer is position sizing, diversification, cash reserves, and realistic expectations. Risk management keeps you in the game. There is another trap in 2025 and 2026, confusing elevated participation with easy profits. Reuters reported JP Morgan analysts saw retail cash flowing into U.S. stocks rise 53% year-over-year in early 2025, surpassing the meme stock pace of 2021. David Russell called the current environment a golden age of retail investing. That phrase contains both opportunity and warning. It is a golden age because access is better than ever. Fractional shares, no commission trading, low-cost ETFs, Roth IRA platforms, automatic investing tools, and educational resources have lowered barriers. But easier access does not remove market risk. It only removes excuses. Tools have improved. Human behavior has not. Let's talk about trading, because the second half of the question is how to make money from stock market trading. The first answer is blunt. Most people should not depend on active trading as their primary wealth-building method. FINRA Foundation's 2024 Investor Survey Report, published in December 2025, found 36% of respondents made 4 or more trades in non-retirement accounts over the prior 12 months, 31% made 1 to 3 trades, and 25% made none. Activity is common. Skill is rare. Frequent trading can generate taxes, spreads, slippage, emotional errors, and concentration risk. It can feel productive while quietly reducing returns. Motion is not progress. That does not mean trading is impossible. It means trading requires a different standard. If you want to trade, treat it like a risk-defined side process separate from your long-term investment plan. Use only money you can afford to expose to higher volatility. A practical guardrail for many retail investors is to keep 80 to 95% of investable assets in long-term diversified holdings, and limit 5 to 20% to active ideas, depending on knowledge and discipline. Even within that smaller sleeve, position size matters. If your trading account is $10,000, risking 5% on one idea means a $500 exposure to loss if your stop or thesis fails. If you risk 20% per idea, a short streak of losses can do serious damage. Small losses are tuition. Large losses are setbacks. How do traders actually try to make money? Usually through one of 4 edges. Trend following, where you buy strength and cut weakness. Mean reversion, where you bet extreme moves will normalize. Event-driven setups, where earnings, product launches, or policy decisions shift valuation. Or valuation dislocations, where price diverges from business fundamentals. But here is the critical point. Each approach needs rules before money is placed at risk. Entry, exit, maximum loss, time horizon, catalyst, and post-trade review should all be defined in advance. Otherwise, you are not trading, you are improvising. Beginners should also understand that taxes change net returns. Hold a stock for less than a year in a taxable account, and gains are generally taxed at short-term rates, which are usually higher than long-term capital gains rates. Trade frequently, and the tax drag grows. Add transaction costs, even in zero-commission platforms, because the bid-ask spread still exists. If you buy at $50 and can only sell immediately at $49.95, that spread is a real cost. It looks invisible because it is not shown as a fee, but it comes out of your return anyway. Gross return is not your return. Net return is what counts. A better beginner path is barbell behavior. Let the core of your wealth compound in diversified index funds, ETFs, a 401k, and a Roth IRA. Then, if you are deeply interested in markets, carve out a small sandbox for learning. Use paper trading first. Journal your setups. Track whether your gains come from a repeatable edge or random luck. If you cannot beat your own benchmark after costs and taxes over a full year, the signal is clear. Keep the long-term system and reduce the trading sleeve. Ego is expensive. Now let's connect this to specific account order for a typical working professional. Step 1. Pay off toxic debt. If you carry credit card debt at 20% interest, paying that down is mathematically equivalent to earning a strong guaranteed return. Few investments can reliably beat a 20% borrowing cost after tax. Step 2. Build the emergency fund. Step 3. Contribute enough to the 401k to get the full employer match. Step 4. Fund a Roth IRA if eligible because of its tax-free growth potential and investment flexibility. Step 5. Go back and increase 401k contributions toward your long-term target. Step 6. Invest additional taxable money into low-cost ETFs or index funds. Order creates efficiency. What about stock picking? You can make money owning individual companies, but the burden of analysis is much higher. You need to understand revenue growth, margins, cash flow, debt levels, valuation multiples, industry competition, management incentives, and the difference between a good company and a good stock at a given price. Those are not the same thing. A wonderful business can still be a poor investment if purchased at an excessive valuation. For beginners, picking one or two companies because you like the product is not research. It is familiarity bias. Respect the difference. This is also where diversification beyond traditional stocks and bonds enters the conversation. Schwab found about 2/3 of Americans said investing success today requires going beyond traditional stocks and bonds. That does not mean beginners need complex alternatives on day one. It means people increasingly recognize that asset allocation can include real estate investment trusts, treasury ladders, money market funds, high-yield savings, commodities exposure in limited form, or international diversification. The smart response is not to chase every category. It is to understand what role each asset plays. Diversification is not owning many tickers. Diversification is owning assets that behave differently for a reason. For most viewers, the highest value version of diversification is still boring and powerful. Broad stock exposure for growth, bonds or cash for stability and planned spending, tax-advantaged accounts to improve after-tax outcomes, periodic rebalancing to control drift, automatic contributions to remove emotion. If your allocation target is 80% stocks and 20% bonds, and a strong stock rally pushes it to 88 and 12, rebalancing brings risk back to plan. That discipline forces you to trim what has run up and add to what has lagged. Buy low and sell high sounds easy in theory. Rebalancing is one of the few systematic ways ordinary investors actually do it. Let's use a concrete dollar example. Suppose you earn $90,000 per year. Contribute 10% to a 401k, receive a 4% employer match, and invest another $300 per month into a Roth IRA. Your annual 401k contribution is $9,000. The employer adds $3,600. The Roth IRA adds $3,600 per year. Total annual investing becomes $16,200. At an 8% annual return, after 10 years that contribution pattern could build to roughly $248,000. After 20 years, it could grow to around $801,000. After 30 years, it approaches $1.84 million. Those are not fantasy numbers. They are the arithmetic of consistency. What usually breaks that plan is not lack of access, it is behavior. Chasing hot themes after the move. Selling diversified funds during a correction. Holding too much cash for too long because uncertainty feels uncomfortable. Or trying to outperform with constant trading when the long-term plan was already good enough. The market often rewards patience more than brilliance. Schwab's survey found nearly 70% of investors say they are more patient now than when they started. That may be one of the healthiest findings in the entire dataset. Patience compounds. If you are completely new, here is the simplest starting checklist. Open the correct account before buying the first asset. Choose a 401k if a match is available. Open a Roth IRA if eligible. Select one broad U.S. stock index fund or ETF as your core. Add an international fund if you want global exposure. Set automatic contributions on payday. Reinvest dividends. Review allocation once or twice per year, not every day. Ignore short-term noise unless your financial plan has changed. Simplicity scales. And if you insist on learning trading, build guardrails. Start with paper trading so your mistakes are informational, not financial. Pick one strategy only, not 5. Define entry, exit, and maximum risk per trade. Avoid leverage early because leverage magnifies errors. Track every trade in a journal with setup, thesis, size, result, and lesson. Compare your performance to a passive benchmark. If your active account underperforms for long enough, you have your answer. There is no shame in choosing the lower stress route if it produces the better net outcome. Results matter. One more point that deserves attention is education quality. In a market flooded with opinions, beginner investors need credible sources. Lori Schock put it well. Whether you're new to investing or a seasoned investor, Investor.gov has resources to help investors build long-term financial security. That is the right mindset. Learn from sources that explain risks, costs, time horizon, diversification, and fraud prevention. Be skeptical of anyone selling certainty. In markets, certainty is usually marketing. So how do you start investing in the share market? You do it in the right order. Stabilize cash flow, eliminate destructive debt, capture your 401k match, use a Roth IRA when appropriate, buy low-cost diversified ETFs or index funds, automate contributions, rebalance periodically, stay invested through normal volatility. And only after that foundation exists should you use a small, controlled sleeve for trading or individual stock ideas. Wealth is built with structure. How do you make money from stock market trading? By first accepting that trading is not the default path to reliable wealth. If you still choose to pursue it, make money by controlling losses, defining setups, respecting taxes and costs, sizing positions conservatively, and measuring performance honestly against a passive benchmark. The traders who survive are not the ones who predict every move. They are the ones who manage risk better than the crowd. Survival comes first. Right now, retail participation is high, stock ownership is elevated, and cash is flowing aggressively into equities. Access has never been easier. But the real edge is still the same one it was decades ago. Discipline, diversification, low costs, tax awareness, and time. That edge is available to beginners today. It just does not look exciting on social media. Quiet systems win. If you want more clear, data-driven breakdowns like this, subscribe to YieldWire so you can build your portfolio with evidence instead of headlines. Then drop a comment with this question. If you were starting with your next $500 today, would you put it into a broad index fund, a single stock, or keep it in cash, and why? Finally, save this video for the next time you need to decide between a 401k, Roth IRA, ETF, or index fund, because the best financial decisions are usually the ones you make calmly, not quickly. This video is for educational purposes only and is not financial advice. Always consult a licensed financial advisor before investing.